Financial literacy is more crucial than ever. But unfortunately, different people have different interpretations of the term financial freedom. Some people define financial freedom as the ability to buy whatever they want, whenever they want. For many, it could mean not worrying about how they will pay their bills or unexpected expenses. For some, it may simply mean becoming debt-free, whereas for others, it may mean having enough money to retire. While all of these interpretations are partially correct, they are all half-baked solutions. As ironic as it may sound, financial freedom is about control, specifically control over your finances. So one of the better ways to define financial freedom is to have enough residual income to live the life you want without worrying about how you'll pay your bills or deal with unexpected expenses. There are many more. So watch the video till the end to know how to achieve limitless financial freedom. And if you enjoy such content, make sure to like this video, subscribe to our channel, and turn on the notification bell icon to never miss another upload of ours. Here we begin. Number 5. Be aware of your credit score. Your credit score is crucial in determining the interest rate you are offered. Whether financing a home or a new car, it also affects how much you pay for a variety of other necessities, such as life insurance premiums and auto insurance. Because someone with hazardous financial habits is thought to be likely to also be reckless in other aspects of life, such as not taking care of their health or even driving and drinking, credit ratings are given a lot of weight. This is why it's crucial to obtain a copy of your credit report frequently to ensure that no inaccurate negative information tarnishes your reputation. Investing in a trustworthy credit monitoring service may also be worthwhile. Number 4. Now is the time to invest. People may doubt the idea of investing during bear markets, but historically, there has never been a better chance to increase your wealth. Your money will expand tremendously thanks to the magic of compound interest alone, but you'll need a lot of time to see real growth. However, keep in mind that trying the type of stock picking made popular by billionaires like Warren Buffett would be a mistake for anyone other than experienced investors. So instead, open an online brokerage account that enables you to easily learn how to invest, build a modest portfolio, and automatically add funds to it every week or month. To assist you in getting started, we've listed the top online brokers for beginners. Number 3. Maintain your health. Taking exceptional care of your physical health has a major positive impact on your financial health as well. The notion of regular maintenance also applies to your body. It is simple to make an investment in your health. It entails going to the dentist and doctor on a regular basis and adhering to medical recommendations for any issues you experience. In addition, simple lifestyle adjustments, including increasing exercise and eating healthier, can help or even prevent many medical conditions. On the other hand, poor health maintenance has adverse short and long-term effects on your financial objectives. For example, because some employers only allow a certain number of paid sick days, money is lost once those days are used up. Poor health also raises insurance prices, as do obesity and other dietary disorders. Number 2. Automatically save money. First, pay yourself. Enroll in the retirement program offered by your workplace and make use of any matching contribution benefits, basically free money to the fullest. It's a good idea to set up automatic contributions to a brokerage account or a similar account and withdrawals into an emergency fund that can be used for unforeseen needs. The money for your emergency fund and retirement account should ideally be taken out of your account the same day you were paid, so it never even comes into contact with your hands. Bear in mind that your specific situation will determine how much money is advised to be saved in an emergency fund. Additionally, you shouldn't use a tax-advantaged retirement plan as your sole source of emergency funds because of the limitations that make it challenging to get your funds if you unexpectedly need them. Number 1. Determine your life's objectives. How do you define financial independence? Everyone wants it in general, but that's a very nebulous objective. You must be precise with regards to sums and due dates. The possibility of completing your goals increases with their level of specificity. Put these 3 goals in writing. Firstly, the requirements of your lifestyle, the amount that needs to be in your bank account to enable that, and the age at which you must have saved that amount. Establish financial mileposts at regular intervals between the 2 dates as you work your way backward from your deadline age to your present age. Put the target sheet at the front of your financial binder and be sure to write down all amounts and deadlines precisely. So what about financial planning in the new era versus traditional financial planning? Let's discuss. For traditional financial planning, you will normally meet with a financial expert, often known as a financial planner or advisor. Financial consultants will review your accounts and assist you in identifying areas for improvement. They can assist you with a number of things, including risk management, retirement, and asset management. Keep watching to know more information regarding the benefits and drawbacks of hiring a financial advisor, the expense of doing so, and other related topics. Why do you need to think about hiring a financial planner? A financial planner's key duties include helping you manage your wealth, understanding how your finances function, and eventually assisting you in setting and achieving financial goals. Of course, they can also assist you in times of economic uncertainty or disaster. The benefit of hiring a financial planner is that they keep you focused, hold you accountable, and ensure you don't make illogical decisions, especially when the economy is struggling. What is the price of conventional financial planning? The cost of financial planning has undergone a significant change throughout time. For a very long time, a set proportion of the client's portfolio was the most common method of charging. Additionally, advisors received and still receive commission for particular product categories, insurance, investments, etc., that they would promote. This practice has gained notoriety since it makes it challenging to behave in the client's best interest when some goods carry higher commissions than others. The benefits of conventional financial planning. In the old school of financial planning, you would schedule regular office meetings with an advisor when you would sit down and discuss your financial objectives. There are several advantages to that, but the human element is the most valuable one because personal finances are so personal. You are very fortunate if you have a trusted advisor on who you can rely on. Drawbacks of conventional financial planning. The more clients an advisor has, the less time you will have to meet in person or have in-depth interactions with them. They frequently will have more resources at their disposal, but they won't always be able to provide you the attention you require as a client. That's acceptable and even how some people would like the relationship for others. Others, particularly those who are getting close to certain objectives like retirement, would rather spend more time with their advisor. Another drawback is that not all counselors will behave in your best interest. This has historically been impacted by some goods and services paying out more commissions than others. How should I choose a financial planner? Until recently, most investors only paid attention to investing in different types of assets, such as mutual funds, insurance, gold, etc. Rarely was this supported by a consideration of financial planning. Now, however, many of them are attempting to put up a financial plan that will direct them in terms of how much money to save and assist them in choosing the best investment vehicle. This is carried out following a thorough analysis of their risk profile, income, expenses, and current investments. Today, nearly everyone in the financial services sector claims to provide financial planning services. Indeed, large banks, brokers, and providers of financial services have established departments or divisions that are dedicated to financial planning. When should you begin financial planning? Many people connect this with age, claiming that they are too young or old to engage in any financial planning activities. Others connect this with money, claiming that they do not have enough money or assume that they do not have enough to enter into any type of financial structure. Call it confusion, an explanation, a rationalization, or whatever else prevents many people from adhering to this methodical approach. And even though they are aware that they require some financial discipline in their lives, they continue to put it off while waiting for the ideal moment. As a result, they are never able to establish a structure. That's all related to how to achieve limitless financial freedom. What is your way to achieve financial freedom? Share with us in the comments below.